I'm Neal Barker, partner with HSG. Been here almost since the inception of the firm. Firm started in '99. I came in 2001. All the other stuff that Kelsey ran through that I've been involved with is mostly stuff that I still occasionally do, but a lot of it's stuff I used to do. These days, pretty much almost exclusively working in the area of comp and compliance, leading those services within HSG. So leading all of our compensation redesign projects, and all of our fair market value commercial reasonableness services. And so I'll let Kari quickly introduce herself.
Thanks, Neal. Yes, so my name is Kari Craig. Like Kelsey mentioned, I'm a senior manager with the HSG team for our employed provider network service lines. And I work closely with Neal on a lot of our different compensation and compliance projects in regards to FMVs, kind of taking a look at, whole systems, compensation, looking at how that aligns with productivity, as we'll get into later in this discussion. But really, my role is the data analytics and, working with our clients to ensure that everything's been validated and, we can take that data and turn it into a report and kind of help fill in where there's gaps or concerns.
Thanks, Kari.
Mhm.
So as we look at our kind of agenda today, so we, not knowing kind of the audience that would be part of the lunch and learn, we start kind of high level, and so we'll talk about FMV and why do we as healthcare organizations, why do we care, and then we'll talk about what FMV is, the different approaches that are on the table, from a valuation perspective, and which approaches are typically the ones or the one selected for compensation, provider compensation, fair market value determination and valuation. And we'll briefly talk about who can determine FMV. What are some of the requirements, if any. We'll talk, specifically about the FMVs and the valuation work that we tend to focus on here at HSG. We'll talk about what Kari mentioned, and where she gets involved is kind of the more complex kind of network level FMV review. So some of the more larger groups that we work with, where it's more data intensive in terms of compensation and productivity data for 300 physicians, 200 APPs, those type of networks that we do kind of a broader review for. So we'll kind of talk about that kind of analysis, and then we'll talk about the test for commercial reasonableness and why it's important, but also why it's different than FMV. A lot of times people wrap those together, but they are distinct and equally as important. So as we jump into it, starting with why do we care about FMV? So if you're a healthcare organization that accepts payment, so reimbursement from government for services from government programs such as Medicare, number one, but then also Medicaid, you do care and you should care. And the reasons that you should care, we have highlighted here. So one, probably the most prevalent, the most talked about, the most focused on law as it pertains to hospital physician relationships and any kind of financial considerations or relationship that the two might have between each other, would be the Stark Law. So Section 1877 of the Social Security Act, also known as the Physician Self-Referral Law, prohibits a physician from making referrals for certain designated health services. And on the next slide, we'll show what designated health services are. Payable by Medicare to an entity with which he or she or an immediate family member has a financial relationship, unless an exception applies. And so secondarily, the Stark Law prohibits an entity from filing claims with Medicare, or where those services have been referred. So, if you're a healthcare organization, a DHS entity that has a financial relationship with a physician, then you care. Anti-kickback statute is another a regulation that hospitals and physicians need to care about. So the federal anti-kickback statute is an intent based criminal statute that prohibits intentional payments, whether monetary or in kind, in exchange for referrals or other federal healthcare program business. And so, reason that we have to make sure that compensation between a hospital and a physician is fair market value is because, if any portion of those payments is considered outside of fair market value, then the intent that could be drawn there is that that overage, that difference, that those dollars outside of fair market value were part of an inducement to make referrals. If your healthcare organization is tax exempt or non-for-profit, then you have to be concerned about the IRS 501c3 tax exempt requirements, and so that's another consideration. So each one of the regulations contains exceptions that require physician compensation arrangements fall within fair market value and be commercially reasonable. And probably the best example for most of the organizations that we work with, which would be hospitals and health systems who, have either W-2 employed relationships or independent contractor relationships with physicians. The example would be that there's a bona fide employment rate relationship exception under Stark that requires that those compensation considerations, be FMV, fair market value, and commercially reasonable. So as mentioned on the previous slide, what are designated health services? So this slide just shows the list of about 12 categories of services that are designated health services. So if you're an organization that provides an entity that provides any of these services and also has financial relationships with physicians who are involved in making referrals for these services, then you care about fair market value and commercial reasonableness. What is FMV? So under the Stark Law, fair market value is given as in 3 different areas. So there's just the general, which would apply to compensation arrangements, and then there's similar but specific definitions that apply to the rental of equipment and the rental of office space. Just in general, the fair market value is defined as the value of an arm's length transaction consistent with general market value of the subject transaction, which would lead you to say, well, what does general market value mean? And so general market value under the Stark Law has 3 specific definitions that apply to assets, the rental of office space, and then the one that for the valuations and the FMV work that we do has a definition that's specific to compensation for services. And so under that definition, it says, with respect to compensation for services, the compensation that would be paid at the time the parties enter into the service arrangement as a result of a bona fide bargaining between between well-informed parties that are not otherwise in a position to generate business for each other. And so compensation is based on the market for those specific services. So for, as an example, a physician's professional services. So what's the value of compensation for those services? And it doesn't take into account the fact that that general surgeon might be able to refer, his or her patients to your hospital, and you would generate, the inpatient, the downstream outpatient, and all the subsequent DHS revenue, from that physician's referrals. You're not taking into account that referral revenue, and so you're not taking into account the other business revenue that physician is able to generate for the organization. We're just paying for the value of his or her professional services. The most recent round and revision of the Stark Law separated and pulled out the volume and value standard. And so that, really kind of going back to what we talked about, generating additional business for the organization. We always have to be sure that the compensation paid under the arrangement is not determined in a manner that takes into account the volume or the value of the referrals by the physician who is a party to the arrangement. We're not considering any of those DHS referrals or the revenue that might be generated there. It doesn't factor into our calculation. It doesn't factor into our thought process. It doesn't, factor into the fact that, well, we're willing to go the extra mile because we get all this downstream revenue, on this particular physician. So we're willing to pay the 90th percentile for him, but this other physician who doesn't refer as much, maybe we're only willing to do the median. That type of thought process is not allowed. We have to separate those two, and we have to focus on just the value of the professional services, irregardless of the downstream volume value of those referrals that physician might make. So valuation approaches. So from a pure valuation perspective, in the appraisal and valuation industry, there's three types of approaches that are at evaluators' disposal. There's the cost approach, which is based on the preposition that an informed buyer would pay no more for an item or service than the cost of producing a substitute or replacing with a property or service with the same utility value as the subject. So the cost approach is one that might be applicable for assets, for the valuation of assets or facilities. Typically, not as much for compensation. The income approach would be, an approach that really is focused on a business. So if we're evaluating, doing a valuation of an ongoing business, and we're trying to decide how much that business is worth for a transaction, then an income approach, looking at the income derived from the ownership of a business. What is that worth? Looking at a discounted future values type of calculation based on that income would be appropriate for a business valuation. But for a compensation evaluation or valuation, the income approach is typically not the approach that one would take. For compensation, the primary approach would be the market or sales comparison approach, where we're looking at market data for services. So as an example, in the case of if we were employing an oncologist, looking at the market data, so in our industry, that would typically be industry surveys that we might purchase, that we might look at. NGMA, AMGA, Sullivan Cotter are three great surveys that we reference in our fair market value work. But also, looking at market data that we might find from job posting sites. Sometimes some really good data, in the timely data that we can find through, in-depth internet searches of job postings to see what's going on in the marketplace. So survey data, and then market data that we can find through research. We kind of feed the market approach with most of the compensation valuations that we would be involved with. And this is just kind of reiterating that. So business valuation, looking at all three of the approaches potentially. But perhaps maybe focused on the income approach, and then a compensation valuation approach, where we're looking at marketplace data. Who can determine FMV? So we tend to focus on the USPAP approach. So USPAP, the Uniform Standards of Professional Appraisal Practice, is an organization that provides standards across the country as for all types of appraisal services. Less specific for compensation. It kind of provides us a general framework and approach and some standards that we do want to adhere to, but it's not very specific to healthcare or specifically provider physician compensation valuation. It tends to be more focused on real estate, personal property, business and mass appraisal than it is on compensation. Within that, there are three different organizations that offer credentials and business valuation. The bottom two, the American Institute of Certified Public Accountants and National Association of Certified Valuators and Analysts, tend to be more accountant and CPA focused, and perhaps a bit more focused on business valuation. The American Society of Appraisers is one that we've kind of focused on and kind of worked with and kind of used as our basis here, and kind of give us those standards that we adhere to. But again, none of them are really focused on standards for compensation valuation, which is where the AAPCP, the American Association of Provider Compensation Professionals, has started to kind of step in to try and start to fill that void in the compensation valuation marketplace and provide some of those standards, and that specific standard ppbody in the marketplace. And so we've been working with that organization, as they get kind of their feet under them and get moving in this area and start to develop across the marketplace. So that the FMVs that we typically provide here at HSG, so for physicians, and so we've kind of broken it out into two categories: physicians and APPs. So physicians being obviously the most predominant area that we focus on fair market value, but we also do appraisals for advanced practitioners. But from a physician perspective, the types of FMVs: number one, clinical compensation. So payment for professional services, which could be for an independent contractor or an employed W-2 employed physician, across a variety, the gamut of specialties, as well as compensation structures, base plus productivity, non-productivity incentives, hourly shift rates, the variety of methodologies and approaches for compensating physicians for professional services. We get into evaluating those arrangements. On-call coverage compensation, so what are we paying physicians for unrestricted call coverage for their specialty or service at the hospital. So, obviously there's a fair market value component, but the commercial reasonableness aspect of this is also very, very important. Is on-call coverage even needed? We look at the burden of call coverage and what that looks like, and can we justify, paying a physician for call in a particular specialty? And if so, what level of compensation makes sense? Advanced practice provider, so APP supervision and collaboration compensation. A lot of organizations, require a physician supervise, mentor, and direct and collaborate with an APP. So what does compensation for that needed service look like, and what kind of requirements are there on the physician per, in exchange for that compensation? So we get into valuing and justifying the compensation arrangement there. Medical direction or medical director compensation. So if we're paying a physician for for administrative services or clinical leadership and medical direction in a certain area, what does that need to look like in terms of fair market value and commercial reasonableness? Service line co-management. So if we're paying a physician or a group of physicians, we'll say an example for orthopedics to help us co-manage our orthopedic service line to improve quality, improve efficiency, reduce cost in our orthopedic service line. What's the value on that? And so how do we value the compensation related to that co-management arrangement? Hospital-based service subsidies. So where we have independent groups providing much needed hospital-based services, anesthesia, ED, hospitalists, critical care intensivists, pathology, radiology, and so on. Where those services have to be covered and provided at the hospital, and we have independent groups that are providing it, but sometimes their revenue, either based on volume, payer mix, or just the payer rates in the marketplace, and the escalating cost of provider compensation don't align. And so there's often a shortfall in their professional revenue that we get involved, or the hospital gets involved in making up the difference. So in those subsidy arrangements, is the compensation appropriate? Is it fair market value? Is it commercially reasonable? And so we get involved in helping with those types of arrangements. Professional service arrangements, which could be for any specialty across the continuum. What does that look like? So we're paying a physician or a group of physicians and their advanced practitioners for professional services. So what does that look like in terms of fair market value and commercial reasonableness? So perhaps a lot of times similar to what the structure might look like for our employed physicians, our W-2 employed physicians, but maybe at a different rate or slightly different structure for independent physicians providing the hospital, with much needed professional services. And then lastly, for physicians, net income guarantees for recruitment of independent physicians. So what does that look like from a fair market value perspective? For APPs, similar to physicians, the primary one that we get involved with there is really just the clinical compensation. so paying APPs for their clinical services and professional services. So what does that look like? Sometimes we get APP arrangements for call coverage and medical direction and PSAs exclusively for APPs. It's not common, but does happen occasionally. So that too would be within the purview and what we do at HSG from an FMV perspective. So at a network level, so lastly, we'll talk about, we do a lot of reviews for organizations, FMV reviews on an ongoing basis at kind of the network level. And so looking at large, broad groups, across the organization, looking at all of their employed and or independent contractor physicians and what we're paying, what the organization is paying them. Is it fair market value? Is it commercially reasonable? How does it align with their production? Typically work RVU production. What is all the other compensation that they might receive? Medical direction, call pay, APP supervision. How does that look? How does that feed their total compensation? And how does all of that align and compare with benchmark data and survey data that you can see that we have highlighted there. And so typically at that type of network level analysis, through a network level compensation FMV review or a network assessment, what does that look like, and how do we use their data combined with benchmark data to evaluate them? And we typically categorize providers into, based on the analysis, into one of four categories that we have listed here. So one, physicians that are assigned to the no concern category are those that we believe where their compensation is within acceptable fair market value parameters, that compensation compliance risk is minimal, and we feel like the model is appropriate and no further action is needed. So that would be, as an example, compensation that's not above the 75th, or above the 75th, but compensation and production percentiles are what we call reasonably aligned. So within 10 percentile points or up to the 90th, or greater than 10% once we hit the 90th percentile. Those are lower compensation levels, or they're very well aligned. The second bucket would be moderate concerns. So compensation of physicians assigned to this category we consider moderately concerning. And this means we believe the compensation compliance risk is high enough to warrant a formal fair market value and commercial reasonableness opinion to formally document that compensation is, as we deemed, fair market value and commercially reasonable. And so that would be physicians whose base compensation is what we might consider somewhat aggressive, so it's above the 75th percentile of applicable benchmarks. Or whose total compensation is above the 90th. And so they have one of those two factors associated with their compensation. They're starting above the 75th, or their end result in terms of total compensation is above the 90th. Those that are a significant concern, and so physicians assigned to the significant concern category, in our opinion, require corrective actions in order to bring the compensation in alignment with fair market value standards. And so for those, if the corrective actions are taken, then we would typically then provide an accompanying fair market value opinion. And so physicians that are in this category when we do the analysis are physicians whose total compensation is above the 75th percentile and total compensation exceeding work RVU production percentiles by more than 10 percentiles or 10% once we eclipse the 90th percentile. And so, they're above the 75th, and they have that misalignment, that gap between compensation and production that's at a level that we think warrants explanation or corrective actions or both. The last category is what we call the monitor category. And so physicians assigned to this category are typically not concerning, because their total compensation is relatively low, so it's below the 75th. But they do have that gap of more than 10 percentiles. So there's a bit of a gap there, but again, the compensation is relatively low. So we feel like it's something that should be monitored going forward. So the 75th percentile, you hear us reference that, and the first thing we wanted to point out is that the final Stark rules that came out a couple years ago. The CMS said in the final rule that for reasons explained in phase 1, 2, and 3, they declined to establish a presumption, a safe harbor as requested by commenters. So there were commenters that were looking to establish the 75th percentile as a safe harbor. And basically CMS said that they were uncertain why commenters believed that CMS policy, that it was CMS policy that compensation set at or below the 75th percentile in a salary schedule is always appropriate, and that compensation set above the 75th percentile is suspect or not appropriate. And basically CMS said that commenters to the Stark law were incorrect, that this is not the CMS policy, that there really is, there is no safe harbor based on salary survey data, that each case is unique and you need to look at those factors in determining fair market value. That being said, while it's not a safe harbor and you have to consider those unique market and specific situation factors, we continue to kind of use the 75th percentile as a guidepost. It's a point where the compliance risk in a compensation arrangement is significantly increased, especially we believe for guaranteed compensation or for base salaries. That's just an area where we feel like you have to go the extra mile if you're going to go to that level. You have to explain why that's the case. So next, compensation to productivity alignment is an area that we focus. And so what this particular slide is focusing on that relative alignment. So looking at the example we're using is sports medicine, and not focusing just on the rate. I know each of the surveys produce and publish a compensation to work RVU ratio, which is a helpful is helpful in your analysis, and it's a data point and a measure to look at. But the rate in itself is not the thing that you want to focus on. It's the alignment that results from that rate that we want to focus on. And so the example here shows taking in sports medicine, taking a median rate and saying, okay, if we have RVUs at the 25th, median, 75th, and 90th percentile, and we're using that 50th percentile comp per work RVU rate, so that rate times the RVUs to calculate comp, what's the relative alignment of the RVUs with the resulting compensation. And so you can see with using a median rate 54.76, at the 25th percentile, we're just below the 25th percentile by 5.6%. At the median, in terms of RVUs, we're at the 54th percentile in resulting comp. At the 75th percentile RVUs, we're at the 78th. At the 90th percentile, we're just about 7% above the 90th percentile. So staying within that 10 percentile and 10% once we hit the 90th percentile range that we like to see. If we use that same methodology and calculation for the 75th percentile, we see that a 75th percentile rate doesn't work. That we start to see more of a gap in terms of the alignment than we like to see. 25th percentile RVUs results in 40th percentile comp. Median RVUs times the 75th percentile rate is the 73rd percentile. And then you could see the others too, and how we've got more of a gap than we would like to see for the compensation that's being produced. This slide comes from the MGMA data dive, which is a helpful tool that MGMA provides when looking at and evaluating the alignment of compensation with production. And it just allows you to actually plot a group's or a physician's compensation and work RVU data versus the data that's in the survey. And so, this one is based on orthopedic spine. And so each of the gray dots represents a physician that has had their data reported in the survey. So their work RVU and production work RVU and compensation data is plotted here. So everyone that responded in that specialty to the survey is plotted here. So you can kind of see, how your data compares to the 155 respondents that are represented as a gray dot on here, and how does our alignment compare? And are we staying within that best fit line, which again is about that 10 percentile gap that we like to maintain. So anyway, it's a very, very helpful tool that MGMA provides. And then the overall data analysis, when we do a kind of a network level fair market value review, would kind of look like this, as we start to pull their data together and look at the results and the relative alignment. And so in the data that we've pulled here, just a subsection of physicians that were categorized initially into that significant concern category. And then we start to try to understand why that is, and can it be explained, or if not, then what corrective actions need to be taken. And so you can see that no physicians here have compensation above the 75th. And so base is none of the base salary is above the 75th. So nobody fell into the immediate categorization as a moderate concern. Physicians 1, 2, 3, 4, 6, 9, and 10. So those that were not highlighted in the turquoise color, all have well-aligned clinical compensation. And so if their other compensation, which is what's kind of driving them being a significant concern, so if that can be validated as being appropriate and also validated as fair market value and commercially reasonable, then we can explain why they were in the significant concern category, and we can pull them out with an explanation as to why they were included there. Physicians 5, 7, and 8, which are highlighted, their clinical compensation is exceeding their work RVU percentiles by more than that 10 percentiles or 10%. And so therefore we have to ask, what's driving that? Is it an issue with the physician's compensation model structure that's driving that? Do we have a physician that's in a guarantee period? Were there other incentives that maybe were included? Was the physician out on FMLA that affects, the work RVU production, but we continue to pay them,
Mhm.
at that base rate? So, what's driving that? What's affecting the results there?
Yeah,
Um,
Neil, and I think too, it's also looking at how are we, valuing the work RVUs. So are we giving appropriate credit for the work RVUs based on the new CMS values? Are we applying modifiers correctly? And are we looking at personally performed work RVU credit for those physicians? So I think in part of the data analysis and validation stages, we spend a lot of time really diving into some of those key pieces in the data so that we can ensure that we're looking at it under the right lens.
Yep, and that's where Carrie, thanks Carrie, that's where she has to spend most of our time is, kind of validating, which is not a small task when you've got a group of, 300 physicians and 200 APPs with, all of their various compensation components and work RVU production, and validating those RVUs is clearly important to this analysis as we're looking for that relative alignment between comp and production. And so, as Carrie said, validating that the work RVU calculations have been done appropriately, modifiers applied, which can have modifiers can have both a positive and a negative effect. If we have, the bilateral procedure modifier, then that potentially has an upward effect, on the calculation of RVUs. If physicians are doing assistant surgeon assisting in surgery, and we're applying the assistant surgeon modifier, then it can have the reverse. It can have a downward effect on RVU. So just making sure and validating that all those the data is correct and appropriate and calculated in a way that matches up with the benchmark data, so that we can do true comparisons is critical to this part of the analysis. And then lastly, if we have physicians that are falling outside of our parameters, are there unique circumstances that are a part of that? And if so, then we need to be able to document and describe those in detail. And given the interest of time, I won't go through each one of them in detail, but you can see, kind of the different factors that might be driving that result, and the structure or the level of compensation. So market data that we look at, we're utilizing specialty specific industry survey data that I talked about previously in these areas. And then again, sometimes supplementing with our own research, on the internet, things such as job postings and whatnot supplement data such as base or total clinical compensation, with the survey data that we rely on. And then lastly, our test for commercial reasonableness. We talked a lot about fair market value and why that's important. But as Stark has highlighted for us, the test for commercial reasonableness is a threshold that's distinct from the standard of fair market value, and has to be defined as we have listed here. And so it's not it's not the same as fair market value, but it's equally as important. We have to be able to justify that an arrangement and that the compensation is commercially reasonable. We have to be able to address both. And a good example, kind of a textbook example of what we mean, is, if we think about having two medical directors, being compensated for medical direction in a service line or department within the hospital, when only one medical director is needed, we could be paying both of the physicians at a rate that we could say, yep, it's fair market value for, a general surgeon providing medical direction, in this service line or this department of the hospital. But because we only need, one physician providing that medical direction, the compensation being provided to one or both of the physicians is not commercially reasonable. It might be at fair market value rate, but it's not justified. It's not commercially reasonable because the work is really only being done by one of the physicians and not both. And so that would be, kind of the textbook, example of what we mean by, being fair market value, but not commercially reasonable, and that we have to be able to justify and satisfy both.